Good afternoon. It is January 29th of 2024. I had to think about that for a second. And this is going to be the last weekly update of January. And time has certainly flown by. But I think overall, when we're looking at the markets, certainly been a month of progress. We started off a little bit noisy to the downside there as things were overbought. We were up 9 straight weeks or something like that. So certainly warranted to have that pullback. And then after that period of consolidation, we've really, at the end of the day, moved back into a period of overbought conditions again. And that'll be the theme of this week's presentation, is that things remain overbought, but bull markets are a function of consistent overbought conditions. So we're again back into this period where we think that there is a likelihood of consolidation. Perhaps we have some downside from here, but it's also going to depend on where in the market you are. And I think that will be a big theme of 2024, which is not necessarily the index going up or down, but where in the market are you invested? And it's really going to be a year of stock selection, sector selection, bifurcation underneath the hood. So we'll go through all of that this week. The title of this week's presentation is what at the end of the day is going to actually happen when the Fed cuts rates. And, I think that the initial sort of reflex is that, well, I just want to pile into risk. And I think blindly taking risk ahead of a rate cut is not necessarily the strategy that we would coach our clients on, coach our teams on. We want to take a more measured approach. So we want to study history. What are those sectors that tend to outperform during rate cuts? And what were those macroeconomic environments during those rate cut cycles? So we're going to go through where the market is today. We're going to look at what are those sectors that tend to outperform or underperform during periods of or when the Fed first starts to cut rates. And then lastly, can energy break out here? We've certainly seen energy pull back in the fall. We've seen this stealth rally that not a lot of people are talking about. That's what we want to see in areas that we're invested in. I'm not a huge fan of being in areas of the market where everyone and their grandmother and their great-grandmother and their great-grandfather are all invested, where my neighbors are asking about the stuff that we're invested in. That's usually a sign that we're getting frothy. So I like the fact that we're having that stealth breakout. I like the fact that not many people are invested in energy and that valuations really are quite attractive there. Now, we did include this chart here on the right-hand side, which is it shows the Wall Street sell side consensus price targets for the S&P 500 going all the way back to 2018. And what's the consistent theme is that no matter what those price targets are, the market ultimately ended up either significantly higher than those targets or significantly lower than those targets. And it's just a really perhaps political or nice way of saying that, honestly, these glorified Wall Street analysts don't really have an idea where the market's going to be at the end of the year. And that's why it really matters where in the market we're invested, the companies we're buying, having discipline around the price that we're buying merchandise at, and not necessarily just trying to chase. And that's something we want to continue to get better at as a firm, as an investment team, and then coaching that discipline both at the advisor and the client level as well. So when we think of the short term here, certainly when we look at the percent that the S&P 500 is trading above its 200-day moving average, as the chart here on the left shows, is that it's overbought, right? There's no doubt about that. But this is a consistent theme that we've communicated as a firm since 2016, and at my prior firm prior to that, is that bull markets are a function of overbought conditions, right? And during a bull market, things can stay overbought for a very long period of time. And it's why that a lot of portfolio managers actually have a lot of trouble navigating bull markets, because they think that, oh, things are overbought, therefore we have to take some money off the table. And certainly things that are working continue to work. Now there are areas of the market that are somewhat concerning, where things have clearly gone parabolic, both from a visual standpoint, but also from a valuation standpoint. Those are the pockets we're trying to avoid this year. And there are other pockets of the market that are truly cheap when we look at the earnings adjusted PE ratios. So here, what I wanted to show everyone was, yes, that S&P 500, if we're looking at the forward PE, it's over 20 times. That is expensive, no matter how you slice that. But when we look at the equal weight index, right? So this is just a easy way of saying, stripping out those magnificent seven stocks that everyone is piled into right now, the S&P 500 is trading around 16 times from an equal weight standpoint. And that's actually kind of around historical average. And then when you go into the financials or the energy sectors, they're downright cheap, anywhere from 9, 10, 11, 12 times earnings. So there are pockets of deals to be had if you're looking in the right areas. And there's certainly pockets of froth and stock chasing and performance chasing if you know where to look to as it relates to the market. So it is not a monolith. We got some expensive pockets. We got some cheap pockets. We got market in line pockets there. And I think the theme this year is going to be that rotation of growth and into value. And semiconductors is right at the center of what we see as a very expensive pocket of the market. You just have to look at those stocks that everyone loves right now, such as AMD or NVIDIA. We're just showing that as a sample set, of course, but those right angles, right? Those right angle parabolic moves to the upside. Certainly, again, we look at the percentage of the price above the 200-day moving average. We're in that, what we call that 95th percentile, 56% of the 200-day moving average. It's hot, right? You're traveling close to the sun there. So we just want to be careful. Are we saying that AMD or NVIDIA are bad companies? Of course not. They're at the forefront of the AI revolution. That AI revolution is not going away. They are the arms dealer in that space. NVIDIA in particular appears to be winning, if not outright won the race. Again, NVIDIA does look like Intel in the late 90s, early 2000s. But at the same time, Intel went through a very, very deep correction in the early 2000s. Why? Because it got very expensive. It didn't mean that Intel suddenly was a bad company. It just meant that the stock got way, way too expensive relative to what it was going to earn over the next few years. So again, we just want to be careful. And Tesla's a great example of this. Tesla is a company that appears to be universally loved across the board as a stock, right? It's got that religious following to it. That said, despite all that love, despite that following, that stock is really beginning to crack, right? So when we look at since December, we've gone from just around $270 a share all the way down to $184 a share. And it traded down 12% back on Thursday of last week. So again, you can have a love stock, a great company, but a really bad performing stock. And Tesla is the first of the Mag 7 to really crack in a reasonable way. And we think there will be others that follow within that Magnificent Seven group. And we, of course, are not positioned in those areas. We're positioned in what we call the average stock of the S&P 500. So what is not as overbought? Small caps, right? Small caps are still trying to break out of this multi-year consolidation. It's certainly not overbought or oversold. We think that this is the beginning of a new bull market for small cap stocks and value stocks. We're using the financials as an example, but we can certainly pull up charts such as energy or consumer discretionary, pockets of the consumer discretionary, X Tesla, X Amazon. And again, that same thing where we're seeing some of the value components within those sectors start to break out relative to the S&P 500. And the common theme here is that steepening yield curve, right? So when we go back and look at those sectors, these are sectors that do tend to outperform historically when the yield curve steepens. And when we look at the yield curve, and we showed a different chart last week of that steepening yield curve, is that it continues to steepen. So we said to ourselves, from a historical standpoint, if we're in a steepening yield curve where the economy is not clearly entering a recession, what are the sectors that tend to, from a historical standpoint, outperform? And there was three clear themes: bank and insurance stocks, energy and resource stocks, and then of course small caps over large caps. Why? Because as the Fed is cutting rates, and we think they're going to cut not necessarily as much as the market's pricing in our opinion, but that tends to put a floor on sort of the what we would call the recessionistas and the forecasts around recessions. And you see sort of an implied economic acceleration, you get a steeper yield curve. And that tends to you tend to see small caps outperform that are very economically sensitive, or commodity stocks, for example. And we think there's perhaps a China component to be had there as well on the commodity side. And then bank and insurance stocks, because of that steeper yield curve, you are borrowing short, lending long, so you get those wider margins on your lending business. So that's a fantastic setup in our opinion for these sectors, and of course in the backdrop that they're very, very cheap. So back in the mid-90s, we had the Fed pivot from attacking inflation to stopping their rate hiking campaign to eventually implementing some rate cuts in a non-recessionary environment. What did that look like from a sector performance standpoint? Notice what happened. As soon as they stopped hiking rates and they went into rate cut mode, technology as a sector corrected 25%. Now remember, the S&P 500 was really painful in 2022, and it went down 22%. So 25%, to go down 25% will be very painful if you're over allocated into those growth areas. And remember, if it's down 25%, there's going to be a lot of stocks there that are perhaps down 40, 50, 60, 70%. So we want to be really careful. So what are those areas that did perform? Well, one of the top performing sectors were financials, right? Because that's steepening yield curve. And again, you see that aligns with the peak in the Fed funds rate and then a gradual rate cut campaign. That's what we want to see: a stable economy, steeper yield curve, higher lending volumes, and wider margins. Great for the banks. And then at the same time, we're also starting to see those other economically sensitive areas trying to break out, such as oil. Whether you're looking at WTI here stateside or overseas Brent oil, as that is priced, both are trying to break out of this recent consolidation. So what could cause oil to break out? Well, certainly China. If there's one market that has not participated in this global rally, it has been China. China's in a downright deep bear market. And in fact, over the last week, we've started to see panic selling, right? So the percentage of stocks at 52-week lows spiking in that 50% plus category. That is usually a sign that perhaps markets are reaching panicked lows and that you may want to step in and buy. Now, we're not playing China, but we are playing, in a way, a second derivative of China, which would be commodities, right? And so if China does step in with that, what we call that stimulus bazooka to arrest the panic that is taking place over there, any sort of stimulus that's introduced in a large way, we definitely think that will be very significant for commodities in a positive way. And you, again, going back to this chart here, already trying to break out, perhaps some people, some traders out there sniffing that China may be coming and introducing a bazooka to introduce significant stimulus. That would tie in again with these panic lows, oil trying to break out. That's where we see sort of as that next step there as it relates to where we are positioned to generate alpha in the portfolio. So is it time for a value breakout? In summary, stock market, again, is working off another overbought condition. We don't see any significant red flags outside of technology and growth stocks. We would be very careful there. We do think value is poised to benefit from that rotation. And of course, oil attempting a breakout that we think will resolve itself to the upside. That's what we got for you this week. I hope you have a fantastic week. 888-543-3776 if you have any questions. Outside of that, again, have a great week. Thank you for your business. And please feel free to reach out to your advisor if you have any further questions. Thank you.